Welcome to the Accounting for You podcast, brought to you by the accounting firm of Adkins and Reynolds CPAs. This podcast is designed to provide relevant tax and accounting information to help you and your business succeed. If you enjoy listening in, please like and subscribe to our channel. Now, on to the show. All right, well, welcome back to our episode number 2 of the Accounting for You podcast. Again, my name is Chris Reynolds. I'm a CPA and partner with Adkins and Reynolds CPAs.
And I am Jay Adkins, partner and CPA at Adkins and Reynolds CPAs.
Last episode, Jay, we talked about some tax tips to get yourself ready for the end of the year. And we wanted to kind of expand on one of those tax tips, and that is the whole idea of buying something at the end of the year to save money on taxes. I cannot tell you how many times I have heard people say, well, my former accountant used to tell me I need to go buy something. And I'll just ask them, do you really need what you're buying? Because that may not be the best idea. You have ever had that happen to you?
I have many times. And as we talked about in a previous podcast, there are different ways that we can help you lower your taxes. So definitely going out to buy something may not be the best thing. We need to take a lot of different things into consideration. Maybe there's other ways, like we spoke about before, retirement contributions or other different things. It may not be in your best interest to just buy something now.
Yeah. So we've got some common misconceptions that we want to just get out of the way right off the bat. The first one is buying something at the end of the year is the best way to avoid taxes. Yeah, but, right? I mean, we're talking, you've got to spend the money in the right way. You don't just go buy, a big piece of equipment that you don't need, because again, let's say you spend $100,000 on a piece of equipment in December, you get it placed in service, you don't need it. Okay, you've spent the $100,000, now you're really saving maybe 25, 30% on your tax bill, but you're still out $70,000 that you didn't need to spend. I mean, in my opinion, that's a great way to go broke.
Absolutely. And you have to take into consideration not only your tax deduction, but also the economics of it. The example that Chris gave, when you bought the $100,000 of equipment that maybe you didn't need, you probably borrowed the money too, and now you're also paying interest on that, and you're out of pocket even more.
Yeah,
that's not necessarily a good idea.
Right, and so this all kind of wraps into the second misconception. I'll get 100% return on my purchase at the end of the year with my tax savings. No, you only go. If this is a tax deduction, not a tax credit. With tax credit reduces dollar for dollar taxes, but we're talking here tax deduction. So you only get to deduct it against your income, which is only going to save you, your marginal tax rate or that last tax rate that you've got. So again, it's not 100% rate of return. Okay, especially if you're going and getting a loan to buy the piece of equipment. You got, you're straddled with the debt payment. You're straddled with interest. At least for more than a year or two. So, all right, here's the last misconception. I'd rather give 100% of my cash for some asset or purchase just to avoid giving the government their money.
Not a good idea.
Again, it all goes back to the main idea that you don't get 100% return on your investment on this. For tax savings, okay? If you're not going to need the product or the equipment, you're still going to be out that 75%, 70% of cash that maybe for the equipment that you didn't need. So let's kind of talk about this and expand it just a little bit more, and hopefully help you avoid this situation. All right. So first off, we're only going to purchase items at the end of the year that we really need. And we're talking maybe the next 2-3 months, maybe 4 months, depending on what it is and how much you need the deduction. That's if you need the deduction in the current year.
Yes, absolutely. You don't want to purchase something you don't need and waste money. You don't want to purchase something that you may need a year from now, because things may change. You may not need it a year from now. So we're really looking to make a purchase and place the asset in service now that you need within the next few months, because that makes economic sense. That also makes sense as far as the tax deduction, because if you buy it and place it in service in December, the tax deduction is moved up a year from buying the same item in January.
Yeah, and it's also it's important to think about when you're buying this equipment and speeding that purchase up is looking at current tax law. Right now we're under tax law of 100% bonus depreciation for all assets. I mean, that can go away.
Absolutely.
So there may not be that benefit in the future. That may phase out. In previous to the 100% bonus depreciation, there was the Section 179 expensing. And sometimes that was even limited. I think I can remember years that it was only maybe $10,000 of Section 179 bonus depreciation. So that can phase out. So you may have gone out and bought that big piece of equipment expecting that big deduction, and then guess what? Tax law was not in your favor there. So do you have any thoughts on that, with tax law?
Yes, I mean, tax laws, can change from year to year. So we definitely, again, as we mentioned in the previous podcast, that's another thing that's part of our tax planning, to see what's potentially out there and to guide you in what year the deduction would be best for you and when you can take it.
Yeah. Now, another thought is maybe you think, well, I'll buy that piece of equipment now. I'll get that current year tax deduction. But I'm going to sell it in a year or two anyways. I probably don't maybe need it, but I'm going to buy it, get the tax deduction now, and I'll kick the can down the road. Important thing to remember, once you deduct that asset and you turn around and sell it in the future, especially if you've got that bonus depreciation, 100% bonus, or taken the 179 deduction, you're looking at taxable income when you sell it in the future, and you've actually just kind of kicked the can down the road, and that can create major tax problems. I've seen that happen.
Yes, if you deduct the entire piece of equipment or auto or whatever you buy now, you no longer have any tax basis in it. So when you sell it later, that means the entire amount that you receive will be taxable in that year. And certainly you don't want to buy something and sell something in the same year, because then that causes all kinds of depreciation problems too.
Yeah, I agree. And then another thing to consider is I'll have clients say, well, I'll buy it now, I'll get the deduction, and then in a year or two, I'll just take it for myself. I'll just send it to myself. I'll retitle the asset. And depending on your tax structure, that's also like a sale.
Yes, absolutely.
So, you've got to still sell it to yourself, especially if you're organized as an S corporation. You've got to do what's called a constructive sale still at fair value. So you're still back in the same boat. So the point is, you're not going to win if you're just going to buy it now and sell later. You're going to get that current year tax deduction, but you're still going to be paying the tax man at some point. So
yes.
All right. So I guess the big thing that kind of brings all this together, and we kind of talked about this in the last podcast, was tax planning. Okay, so this may not be your year that you need that big tax deduction. Okay, and it very well may be. Most of the time, most people need that current year tax deduction, especially if they're talking with us. Hey, look, we've got an income problem, and we gotta get some of this off the books. Okay, and it may be that this is not your year to need that deduction, and maybe it's best to maybe force that, or maybe not purchase that until the next year. But it all comes down to, what do your books look like, right?
Yes.
I mean, how clean are your books? How do you even know what your income is this year? You got any thoughts on that?
Yes, that's one of the main reasons that we like to do tax planning, is to figure out where you're at. But if the books are not clean and things haven't been updated throughout the year, we can't do tax planning accurately. So if it ends up that we're cleaning up the books after the fact, that really nullifies any potential tax planning. So it's very, very important throughout the year to have clean books, not only for the tax planning, but also for the business owner to have an idea of where they are at any time during the year.
Yeah, because it's nearly impossible to look at your, maybe financials through February of the previous year or the current year and go, yeah, I think now's the time to buy that piece of equipment. I feel like I've had a good year. I mean, you may be able to forecast the weather for April. It's going to be maybe moderately warm and rainy, but it's kind of hard to get it exact. So, yeah. Keeping your books up to date is vital, and that comes with good bookkeeping practices. And I think a lot of our clients do a really good job of keeping those up themselves. Of course, we offer those types of services here, bookkeeping services. We have a team of bookkeepers here that's their main job, is making sure your books and things are up to date, so to allow us to do tax planning, tax projections, and advise you on whether or not now's the time to be buying that big piece of equipment.
One of the things I hear a lot of times from clients that's not necessarily true is everything's fine. I have cash in the bank. You can have cash in the bank and your books can be a little messy. So certainly it would be better to keep your books in good shape. And as Chris said, we certainly can help throughout the year with that. And then when we get to tax planning time, if we have clean books, then we have good numbers to work with and can help you to prepare for the balance due if you have one, or potential deductions to avoid the balance due.
And I think the most important thing, because I like to be selfish and it's all about me mentality here, if you have clean books, it makes the accountants happy.
Yes, it does.
It makes our job much easier to help you actually doing the tax return, but it also helps us help you in planning and forecasting your tax situation for the future. So
yes, and absolutely every business owner should have clean books and should understand what's going on with their books because it helps them make better decisions all around.
Very good. All right. Well, I think that's about all we've got for this episode number 2 of the Accounting for You podcast. So again, if you've got any questions or comments, don't hesitate to reach out to us, and we'll see you on the next time. Thank you for taking time today to listen to our podcast. We appreciate listeners like you and ask that if you enjoy what you hear, please like and subscribe to our channel to ensure you receive the latest episodes as soon as they come out. If you have any questions about the topic we discussed today or would like more information on becoming a client, please do not hesitate to contact our office by visiting arcpas.com or theaccountingpodcast.com.